When it comes to finances, there are some smart rules that can help you make better decisions and manage your money effectively. Here are some important financial rules you should know. Rule of 72. The rule of 72 is a quick way to estimate how long it will take for your money to double at a given interest rate. Simply divide 72 by the interest rate and the result is the approximate number of years. 50-30-20ths budgeting rule. This rule suggests allocating 50% of your income to essential expenses, such as rent and utilities, 30% to discretionary spending, entertainment and dining out, 20% to savings and debt repayment. Pay yourself first. This rule emphasizes saving or investing a portion of your income before spending on expenses. Make it a priority to save a certain percentage, such as 10% of your income, to build an emergency fund and contribute to long-term goals. 20% down payment rule. When buying a house, it is generally recommended to put it down. At least 20% of the purchase price is a down payment. This can help you avoid private mortgage insurance and lower the overall cost of your mortgage. The 30% housing rule. To maintain a healthy budget, it's generally recommended that you spend no more than 30% of your monthly income on housing expenses, including rent or mortgage payments, property taxes, and insurance. The 4% rule. The 4% rule is a guideline for selecting retirement savings. He suggests that you withdraw 4% of your pension savings in the first year. Adjusted for inflation in subsequent years, your savings should last around 30 years. Rule of 3. When shopping, especially for non-essential items, think 3 days before you buy. This rule helps prevent impulse buys and gives you time to evaluate whether it's a wise move with your money. Law of compound interest. Compound interest is the concept of earning interest not only from the initial principal, but also from the accumulated interest. The longer your money stays invested, the more it can grow exponentially over time. Avoid high-interest debt. It is generally recommended to avoid accumulating high-interest debt such as credit card debt. High-interest debt can add up quickly and be difficult to pay off, putting a strain on your finances. Diversify your investments. Spreading your investments across different asset classes, stocks, bonds, real estate, etc., and within each asset class can help reduce risk and increase the potential for long-term returns. The 10-second rule. Before you make a purchase, ask yourself if you would still want or need it. The item was 10 seconds after viewing it. This rule will help you distinguish between impulse purchases and thoughtful spending. Lifetime earnings rule. Consider potential lifetime earnings associated with major financial decisions. Evaluating the long-term financial impact can help you make informed decisions about investing in your education or professional development. Pay yourself first. Allocate a portion of your income to savings or investments before spending on other expenses. This ensures that you prioritize saving and building wealth. Live within your means. Avoid spending more than you earn. Create a budget to track your income and expenses and make sure your expenses are less. Save for an emergency. Create an emergency fund that can cover at least 3 to 6 months of living expenses. This fund acts as a safety net and protects you from unexpected financial difficulties. Diversify your investments. Don't put all your eggs in one basket. Diversify your investment portfolio across different asset classes, such as stocks, bonds, real estate, etc., to reduce risk and increase return potential. Remember that finance is a dynamic and evolving field, so being informed and constantly educated about financial matters is essential.